Welcome back to the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth in successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falash, and the Group Practice Accelerator podcast is on the air. Well, today you're going to want to grab a pen and notepad because my guest is going to give us his legal perspective on a couple of topics that all healthcare owners need to understand and be proactive about, because frankly, reactive is never good without exception. So we always want to seek expert advice. And having been fortunate enough to practice as a paralegal for a few years, the tail end of my clinical career, I'm super excited that we get to geek out with today's guest. But enough about me. I would like to introduce today's guest, Geoff Cockrell, partner at McGuireWoods, who is an expert in many areas, not the least of which is mergers and acquisitions. Geoff, welcome to the show.
Thanks a ton.
Well, great. We've got a lot to cover here in terms of your perspective and experience, but let's start with some basics. We have some new listeners joining us all the time, so I kind of want to start with your background and then who's McGuireWoods?
Sure. So I'm Geoff Cockrell. I'm a partner at McGuireWoods. McGuireWoods is a large law firm with around about 1,000 attorneys spread out across the country. I'm an M&A and private equity attorney, representing either kind of buyers or sellers in almost exclusively healthcare transactions across a number of different kind of healthcare subsectors. I know you all do a lot of dental advisory work, and I've done hundreds of DSO transactions, both platforms and add-ons, and have seen kind of all versions and stripes of those, and happy to talk about things I've learned over the years.
Oh, that's wonderful. Well, you beat me to my next question about what they do in the space and specifically what your sweet spot is. I know that Polaris works closely with you and our sell side and our M&A work, so we appreciate your expertise today. Thanks again. Let's start with getting your legal perspective coming out of 2024 and kind of with 2025 well underway. I want to get your thoughts on the M&A outlook for the lower middle market and what that looks like, because for some of our listeners, they were telling us that they were holding off making big decisions or transacting until the administration changed. Has that been your experience as well?
I'm not sure. I think the administration change was the driver. I think in 2024, dental as a sector had enjoyed only tailwinds for a number of years for a number of reasons. The availability of kind of selling to a larger practice opened up transition planning for practices that just didn't exist at all. There were ways to kind of create value by kind of buying smaller things and put them into kind of a bigger company. And then that bigger company would trade at a higher multiple of kind of the cash flow of that business than the smaller thing did, which that kind of creates value and would drive kind of M&A activity. There's also an ease with which capital could be drawn into funding those acquisitions. The interest rates were legendarily low for a legendarily long amount of time. So all those tailwinds were propelling kind of consolidation. And coming out of the pandemic, a number of those things changed. The cost of capital became much more expensive. There were pressures on labor that made attracting and retaining people more difficult than they had been before. The cost of capital also kind of put pressure on kind of the cash flow of acquiring businesses. There were a number of mounting headwinds that made it much more difficult to transact. In addition to, as those kind of headwinds began to mount, there continued to be a disconnect or a growing disconnect between the valuation expectations of buyers versus the valuation expectations of sellers. And there were going to necessarily be valuation changes in response to those headwinds, but that didn't translate very easily into seller expectations. And so all those things put together created a declining M&A environment in lots of parts of healthcare investing in general and dental in particular.
Yeah, absolutely. There are so many factors that went into that. And what are you seeing as 2025 kicks off here? I know we're only, what, 5, 6 weeks in, maybe? How's that looking so far?
It's looked better than 2024 has. Maybe some of those headwinds persist, but some are getting incrementally better. Labor pressures kind of ebb and flow, and they're probably not as sharp as they were last year. Rates are at least stabilized. It's not as cheap to borrow money as it was before, but those have at least stabilized. I'm starting to see an increased degree of alignment in pricing expectations between sellers and buyers. So all of those things kind of point in the direction of better M&A activity, and it certainly looked that way kind of here from the start of 2025. We'll have to see what happens as the year unfolds.
Yeah, absolutely. It certainly feels like things are moving in a direction of what I'll call normalization, where expectation starts to meet reality a little bit better after the pandemic and then conditions before that, of course. So, thinking of all that and speaking of transactions specifically, what are some of the other reasons transactions didn't close or didn't happen just in the last couple of years that you've seen?
One of the bigger drivers, as I mentioned, has been kind of just pricing disconnects, as in particular, smaller practices had difficulty absorbing a lower multiple as a purchase price. That's a tough pill for sellers to accept. Oftentimes, it's a business that has done nothing but improve year over year, yet they're being told that because the multiple is a little bit lower, their price, in fact, didn't go up and may have gone down. That takes a little while to acclimate to. I'd say that'd be one of the reasons. A number of incrementally larger platforms found themselves in some measure of distress. Some of that was driven by some of the concerns we've talked about labor pressures, but some of them just had balance sheet difficulty created by the cost of capital, where their rates aren't locked in for 15 or 30 years like a home mortgage. They fluctuate on periodic changes in interest rates. So their debt service costs for prior acquisitions rose appreciably. And that created a situation where there would be less capital available for those acquisitions. It became very difficult to get more leverage. So there was less dry powder to buy things in addition to the headwinds we are discussing.
Yeah, absolutely. And that has been, you put it very eloquently, it's been a tough pill to swallow for people that were maybe thinking about transacting just before the pandemic, didn't take advantage of that change in the market. And then it's sort of been a little bit of a waiting game, according to some who've chosen not to move forward for their various reasons, like you've said. But it's nice to see that shifting a little bit. In fact, I was talking with our sell side advisor, Kyle Webster, this morning, and I know his activity has been picking up significantly. He was busy before, even busier now, just in the last 6 weeks as 2025 is well underway. What do you see in terms of that transaction landscape just as the year kicks off in terms of transactions themselves?
One of the other kind of wild cards that is starting to play out across kind of healthcare investing is pressure on the larger platforms. Consolidation idea is you start with something small, you build it up a little bit, and then there's a kind of upstream buyer that maybe has private equity backing or is a private equity fund themselves that is the buyer, but then that grows and it sells to a bigger one and a bigger one. And eventually that consolidation construct ends up with very large platforms with tons of EBITDA, hundreds of millions of dollars of EBITDA. And the question is, well, what happens then? What's the next thing for those large platforms? Is an IPO an idea? Are there actually going to be larger and larger buyers? Will large buyers start to view those assets as not something that they trade, but that they hold forever? What's the next step for large platforms? And that was a very open question. And when that question is open, that uncertainty ripples down, meaning the little bit smaller ones, they become less attractive to those bigger ones to buy. And then if that's true, that trickles its way down into smaller platforms. Eventually, you get down to much smaller ones, and they kind of behave in their own market. But that pressure from uncertainty around some of the larger platforms has had an impact on the market as well. And then across healthcare, some of those dynamics have began to loosen up. That larger buyers have been buying from other large sellers in a way that had been muted in 2024. So you're seeing larger strategics renewing their acquisition posture. You're also seeing some different kinds of buyers and different kind of sectors. You've got buyers that might be large payers. That can be a buyer in healthcare. And certain sectors in healthcare, you've gotten kind of pharma companies that view certain large provider businesses as distribution arms for some of their drugs. That's probably less applicable to dental, but you've seen a gradual loosening of the larger end of the market. There's still some uncertainty, especially in dental. There's a few much larger platforms that the future is still a little bit uncertain on, but that kind of high end of the market is loosening up a bit. And that's another emerging tailwind as that begins to loosen up.
Well, it'll certainly be interesting to see how that all plays out given the consolidation ramp up of the last handful of years. So, more to come on that one. We're going to have you back and talk about it again as this all plays out. I know this is something that your firm handles for clients as well, and we want to get your insight on. Let's talk about for a couple of minutes what employment issues look like in terms of M&A activity. What should people be thinking about?
I would kind of lump that into the slightly broader topic because there's a lot of nuance in the employment agreement itself. But to me, one of the kind of through lines of platforms that have had success versus platforms that have struggled is the degree to which you're able to kind of structurally and economically achieve provider alignment. And there are some through lines, I think, from of those structures that you can start to see where the platforms that have had success have some unifying characteristics on how they think about provider alignment versus those that don't. And since you're talking about provider alignment, it kind of invokes a number of elements in the relationship between the provider and the platform. And that takes a number of forms. And I would put the most successful model, in my view, as models that employ some version of what I'll describe as a JV model, where and maybe it's easier to contrast that versus what I'd call not a JV model, where rollover from acquisition targets come in at the topco level, as opposed to a kind of subsidiary joint venture where ownership is more directly connected to parts of business that the seller can influence. Another difference between that JV model on just the equity ownership side is that when the selling providers own equity at a topco level, that equity is usually not cash flowing, meaning as money makes its way up to the kind of the mothership, whatever money is there is generally not being distributed out to all the equity owners. It's being used to satisfy kind of enterprise level debt, do other acquisitions, and there's nothing wrong with that. But what gets lost in that model versus the economics of the JV model, where the provider owns in kind of a subsidiary MSO that's connected to the local practice, what gets lost is the current distributions coming out of that JV. And that kind of aligns with what I think is the most critical aspect of achieving provider alignment is incrementally less, and these aren't binary choices, but incrementally less focus on the economics of the second or third bite at the apple and more focus on current cash flow economics to the providers. And that shows up in a couple aspects. One is the one I just described, where the rollover equity, instead of being at a topco, might be down a level at a JV, where A, it's more directly connected to things that the provider can influence, and B, it generally cash flows on a current basis. Another area where I've seen alignment coming together is if in the context of a sale, the buyers need to be very laser focused on what the go forward economics of those providers are going to be on a kind of year by year basis. And in a practice where you've got multiple owners, you're usually creating a purchase price by scraping some of the economics of the sellers at the time of the transaction. And where I think that runs into trouble is if you're scraping economics from the sellers at a level that, while a larger scrape creates a larger purchase price, a larger scrape creates lower go forward economics to the providers. And if those go forward economics on a year by year basis, setting aside second bites at the apple, if those go forward economics are not sufficient to make continuing to work at this practice better than what the alternatives would be, then you're going to run into trouble. So I would say that when you're talking about employment things in an M&A context, the best focus for both the buyer and the seller is to be very laser focused on what the year by year economics of the kind of participating providers is going to be, and maybe be a little less focused on the transaction economics. I know as an M&A advisor that doesn't always line up with what you're mandated to do, but as I look across a bunch of platforms, the ones that have had success have found that success by aligning with the providers in a way that is very protective of kind of current year by year economics.
Right. And that's one of the things that, or one of the reasons I should say, that we focus so heavily on optimization here at Polaris, because people do lose focus on the day to day, the year to year, and what's the value of the practice over time when they're so, like you said, laser focused on getting the second bite of the apple. So great advice, great reminder. I think that everyone needs to keep in mind without losing sight of what's right in front of them. Geoff, well, thanks so much for sharing your expertise with our listeners. Just so much to think about in terms of M&A and activity coming up as versus 2024, making those big decisions and moving forward with it. Getting the right legal advice for the right matters is always a critical first step, as you told us. So, what's the best way for our listeners to reach you?
You can always reach me with a text or a call. That's probably the easiest. I'm available all the time at 312-617-9123, or you can find me at the firm's webpage at McGuireWoods. But a call or a text is always the easiest way to wrangle me.
Excellent. Thank you so much. And thank you for joining us here today. If you'd like to schedule some time with Geoff, go ahead and reach out to him, as you heard, via his contact. Or if you want to schedule some time to learn about any of the Polaris expert advisory services, or if there's a topic that we haven't covered yet that you want to hear something about, you can send us an email to info@polarishealthcarepartners.com, or you can always reach us by visiting our website at polarishealthcarepartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, please leave us a rating on Apple Podcasts, Spotify, iHeartRadio, or wherever you get your podcasts. We'll see you on the next episode of the Group Practice Accelerator Podcast.